Hello, everyone, and welcome. My name is Amanda Waddell, and I'm the training manager here at BVR. Our webinar today is titled Size and Capitalization Adjustments for Market-Based Pricing Multiples. Before we begin, I'd like to remind you that your attendance today is eligible for 1.5 CPE credits. To receive the credit, you must answer 5 poll questions that will appear during the webinar, and you must complete and submit a brief survey within 5 business days. A link to that survey is included with your login email. It's also available on the event page for the program. At the conclusion of today's program, you will automatically be directed to that survey. If you're registered as an additional listener, you must be on your own device so that you can respond to the questions and qualify for CPE. If during the webinar you have any trouble with the audio streaming, please try refreshing your screen to fix the issue. We'll take all questions for our presenters using the Q&A chat function on the side of your screen. Again, to receive your CE credit for today's webinar, you must answer 5 questions that will appear at random times during the presentation. Now, I'd like to introduce today's speakers. Derek Swag is the Chief Executive Officer and co-founder of Value Analytics. Derek is an expert in asset valuation and has performed or contributed to over 1,000 valuation engagements involving businesses, business interests, and intangible assets of privately held and publicly traded companies. Adam Luke co-founded Value Analytics as Chief Technology Officer. His experience across business scales and application domains provides a robust background for producing innovative software services. Derek has also served as a data science bootcamp instructor at the University of California, Irvine Department of Continuing Education, and he holds a PhD in engineering from the University of California, Irvine. Our speakers' full bios can be found on the webinar presentation page as well. And with that, I'll turn this over to you, Derek. Have a great presentation.
Thank you so much. And thank you everyone for attending today and listening to us. Special thanks also to Adam Manson and the BVR team for coordinating. Just to expand upon the introduction, I'm Derek and I'm here with my partner Adam, and we are the co-founders of Value Analytics. I myself have worked in many corners of finance over my career, and I spent a long time in the valuation industry as a valuation analyst myself. And I think that you'll find that my experience as a valuation analyst motivates a lot of what you will hear today. Adam, if you wouldn't mind introducing yourself and giving a little bit of your background as well, that'd be great.
Yeah, sure. So my name is Adam Luke. Like Derek said, I co-founded Value Analytics, and I have a background in data science and software engineering. So long story short, Derek told me what he wanted to build, and I built it along with our contractors and the rest of the team. So that's my role in this project. Derek is very much the finance guy, and I handle all responsibilities relative to the actual platform.
Yeah. And so the two of us came together and we created a platform, and we'll touch on this a few times, but a lot of the implementation of our platform is through an Excel plugin that is available through BVR, and we'll come back to that. That is just so you are aware of the structure. We have kind of a lot to talk about in the first 60% of the presentation today, and then in the latter portion we will be giving a demo which will be explained more. So in this session, we're going to cover the full life cycle of the guideline public company method with an emphasis. Let me just get to the next slide here. Yeah, so with an emphasis on explicit pricing multiple adjustments. To start, we will review the basic steps in this valuation method and explain where pricing multiple adjustments come into play. We will then decompose the pricing multiple itself to see what is under the hood. We'll then explain what it means to make an explicit adjustment to a pricing multiple. And because of its importance, we will briefly discuss the size premium and its relevance in pricing. This is, I think many will agree, the size premium is kind of a hot topic that becomes very important every few years and very talked about. So we will contribute to that conversation. Lastly, like I mentioned, we'll share an automated tool provided by the Value Analytics Excel plugin and made available to BVR users. And what we're going to talk about today is kind of a methodology, and what we'll share in the demo is an automated Excel spreadsheet that will apply the methodology for you should you wish to use it. All right. So I'm not going to bore listeners. Well, I won't intend to bore listeners with information that they already know. But I want to walk through just an overview of the guideline public company method at a very high level. So many of you already know, to start, you form a peer group of firms that are sufficiently comparable to the private company being valued. And obviously this is I'm just glossing over it, but this can be a very time-consuming process, and we'll cover some of the challenges there. Next, one compares the performance of the guideline group as a whole to the performance of the private company to help with pricing multiple selection. The idea here is you're going to try and figure out, how comparable, is the performance of the company you're valuing relative to the peer group you've chosen. Lastly, and again, very high level, one looks at pricing multiple statistics for the group as a whole. And from there, it's up to the valuation analyst to select pricing multiples that apply to the private company. So in this process, analysts have to decide how to incorporate differences between the guideline group and the private company. So do you choose, median multiples? Do you choose upper quartile multiples, or any other multiple within the range of your guideline group? We refer to this portion as like the subjective selection. It's where you're trying to incorporate what you know to choose the correct pricing multiple kind of subjectively. An alternative approach to incorporate information is to make an explicit adjustment to the pricing multiples. And as opposed to choosing from the range of multiples, you're actually going to modify all the multiples to incorporate some type of knowledge. Now, there can still be a degree of subjectivity here, but there are also more objective methods that have grown in popularity in recent years. The approach that we will present falls under this category of an objective, explicit adjustment to the pricing multiples. And the goal obviously is to adjust the pricing multiples for differences between the guideline group and the private company that you're valuing. All right, so before we dive into pricing multiples, I want to talk a bit more about the guideline public company method. Having worked as a valuation analyst for many years, I observed what I'll refer to as a segmentation in the industry on this approach. Larger valuation firms, again, this is just from my experience, almost always consider the guideline public company method. Granted, it may not be used, but it's at least always considered at the larger firms, especially when subject to audits, because many times auditors will want to see an analysis done. However, smaller valuation practices do often skip this method. And after talking to many practitioners, we've kind of recorded both practical and theoretical reasons for this. So on the practical side, we'll start with cost. It's no secret that the cost to access organized public company data is often high. This cost can be negligible when compared to revenues of a larger valuation practice, and we know who all those large practices are. But smaller firms, CPAs, valuation firms that aren't associated with a large corporation, are understandably averse to paying such high fees for just public data. Another barrier can be knowledge, and what I mean here is a repetitive knowledge, more of a muscle memory of having done this method over and over and over again. As with anything, if you don't do something, you can lose kind of the repetitive memory of how to do it. So if a practitioner has not employed this method in quite some time, it may be increasingly difficult to return to the method on future projects. There's lastly, time can also be an issue, especially for smaller firms that have kind of a regular flow of projects. There's only so much time one can spend on any single valuation. And the guideline public company method, as many know, can require a significant amount of dedicated time if it's going to be scrutinized, especially by an auditor. If resources are limited and if a valuation analyst can get away with it, they may choose not to consider public company pricing just to save time. Of course, not all objections to the method are practical by nature. Most practitioners who avoid the method will take a theoretical stance against it. Specifically, public companies tend to be much larger than their private counterparts. I don't think I'm breaking any new ground there. For the most part, because private companies are private, they're the ones that need to have a valuation done, and private companies tend to be significantly smaller than public companies. So by its very nature, this is going to be an issue. Size differences breed a plethora of additional differences, including management depth, access to capital markets, bargaining power with vendors and customers, etc. So, I mean, there's no argument from us. Size absolutely is an obstacle to the guideline public company in many cases. I think the real question is not do these obstacles exist, but can these obstacles be overcome? Lastly, I won't spend too much time on this, but I'll mention the objection that the guideline public company method is simply not needed, which is a response we've had quite often. If evaluation is not being audited, it's possible the scrutiny will be light enough that no one will look for a comparison with public company pricing multiples. And don't get me wrong, there are certainly times when public companies are simply too different from a small, closely held business. I mean, even thinking back in my career when I was working with dental practices and golf courses, gas stations, like there were all sorts of scenarios where public company pricing just was not applicable. With that said, I think the question is not is the guideline public company method needed, but rather should the guideline public company method be considered? It's likely that there are many cases where public company pricing uh, should be considered even if it's not exclusively relied upon. And in those cases, it's important to have the tools available to you to ensure you're conducting the best analysis possible. So while the purpose of this presentation is to demonstrate how pricing multiples can be objectively adjusted for size and more, we'll talk about more, I want to point out that the adjustments touch on these well-known pain points with this method, and that the platform we use to automate these adjustments also addresses some of these other barriers that likely impact whether or not you decide to consider this method. Okay, so let's start kind of digging into the more meaty material here. I know anytime math is shown on the screen, there's an aversion to looking at it, but we'll walk through these very, very slowly to explain exactly what we're doing, although many of you are already well aware of what we're showing. So for the pricing multiples themselves, as many of you already know, multiplying a performance metric by a performance multiple is the same as dividing by a capitalization rate. That is, the reciprocal of a pricing multiple is the capitalization rate. This is something covered in a lot of, ASA, NACFA, BVR, I'm sure has plenty of courses on this. So we have just a small example here. If the pricing multiple is 10, then the capitalization rate, sometimes just called the cap rate, is 0.1, right? Since 1 divided by 0.1 equals 10. Okay, so let's go a bit further now. What is a cap rate? Well, for those who remember, say, the Gordon growth model, you'll recall that a cap rate is equal to the cost of capital minus the growth rate. That's what we have shown here. As a quick aside, I've written about this equivalence in excruciating detail, and if anyone is interested in the connections between capitalization rates and the Gordon growth model, I am more than happy to have that conversation. Our contact information will be at the end. For now, we will take it as well known and a given that this relationship exists. And the last important point here, and really the crux of this entire presentation, if I will, is that the cost of capital can be estimated using the modified CAPM. Now, briefly, not everyone uses the modified CAPM to estimate the cost of capital or the cost of equity. Some people use like a build-up method that's kind of similar but not exactly the same. I think as long as the modified CAPM, many do use the modified CAPM, but as long as you use similar components, you're going to find that what we talk about today is relevant. Let's talk about that. So for those who have forgotten, the textbook CAPM says that the cost of capital is equal to the risk-free rate. Let me just turn some drawing on. So we've got the risk-free rate plus the systemic risk coefficient, which many of you just call beta, multiplied by the equity risk premium, which is here you have the market return minus the risk-free rate. Of course, and then at the end, or sorry, so of course this if I stopped there, if I don't include the size premium, that's like the textbook. That's not the modified CAPM. That's the textbook capital asset pricing model, right? And this only holds under a long list of limiting assumptions. So in the real world, the textbook capital asset pricing model does not have a strong empirical performance for explaining equity returns. This is also something I can provide, many references, many sources, if anyone is interested in contacting us and understanding the empirical shortfalls of the textbook capital asset pricing model. So once it was discovered that the capital asset pricing model is not very good at explaining things in the real world, multi-factor models have emerged to kind of fill in the gap left by the empirical invalidity of the textbook capital asset pricing model, and in steps the modified capital asset pricing model. So here the size premium is appended onto the equation, allowing for size to impact the cost of capital. Now, we'll get into the validity of the modified CAPM shortly, but note that this treatment of the cost of capital is powerful. It allows us to directly connect pricing multiples with size. One thing I'll point out, and I might talk about this again, but in the modified CAPM with this treatment, the size premium is, for those familiar with like basic regression, the size premium is really kind of treated like a residual here. So in other words, everything that's not explained by the systemic risk coefficient, the beta, really kind of falls into the size premium. So it is a little bit of a heuristic approach, but nonetheless, it is quite popular. Okay. So we see here a visualization of how size and capitalization, leverage for that matter, are ultimately just components of the pricing model. Or I'm sorry, the pricing multiple. Many viewers may already see where I'm going with this, since the pricing multiple can be decomposed into a number of variables. We can adjust the pricing multiple. We can adjust the pricing multiple by adjusting the component variables themselves. If the size premium embedded in a public company's pricing multiple were changed to a different size premium, we would be explicitly altering the pricing multiple for size. If the systemic risk coefficient embedded within a company's pricing multiple is changed, we are again making an explicit adjustment. And I just want to walk through this real quickly. So we just established earlier that the capitalization rate is equivalent to the cost of capital, or cost of, in this case, cost of equity, because we're doing a price earnings multiple, cost of equity minus growth, right? And then we just also talked about how the modified capital asset pricing model is a model for the cost of equity. So as you continue to substitute these kind of basically formulas for representing these different things, you end up with a pricing multiple equaling 1 over all of this. So that's essentially what we're saying is, hey, if we can represent a pricing multiple with all of this, then we can just change these individual components, and that will be an explicit adjustment to the pricing multiple. Obviously, this does depend on what we've talked about, i.e., the cap rate is represented as through the Gordon growth model as cost of equity minus earnings growth, and that the cost of equity can be represented as the modified CAPM. One side point here, I'm sure many listeners are familiar with leveraging and unleveraging the beta variable in blue there. But for those unfamiliar, we will explain shortly how the systemic risk coefficient can be altered to reflect different levels of leverage. Now, I do want to also point out that these two variables, the systemic risk coefficient in blue and the size premium in green, are I'll call them semi-observable. You can't say they're directly observable because the calculation of each requires some discretionary modeling decisions. But if you make reasonable modeling decisions, both of these variables can be calculated empirically using historical data. And this is convenient because it means we can estimate these variables for public companies and then change them to better reflect the condition of the private company that we are valuing. All right, so obviously all of this, including the modified CAPM itself, is predicated on the size premium. So I don't think it would be, I don't think it'd be okay to go through this entire presentation without giving serious consideration to the size premium, especially, like I said, it is a kind of a hot topic, and I think every year that passes, it's becoming increasingly not controversial, but increasingly scrutinized. So let's talk about the size premium. The premium, though it is controversial, it is well accepted within the valuation community, and is often encouraged by auditors from my own experience and from the discussions we've had with clients. And the size premium has a long history. The size premium was first observed by Rolf Bands in 1981. He specified size in a unique way, but the premium nonetheless existed up to that point, and thus began the size premium debate. And for those, the size premium, what we mean here specifically is the excess return that small companies experience in equity markets relative to large companies. Specifically, what Rolf Bands found was that smaller firms tended to have higher returns than larger firms, and so that excess on average, he called it the size premium. So what explains the size premium? Well, at least in theory, there are several properties of small stocks that make their risks fundamentally different from large stocks. And I apologize in advance. I know that many of you are very aware of this, but I want to kind of cover it anyways because I think it's important. So to start, investment data, and a lot of this is, by the way, available from, there's, very well-known Ibbotson, then Duff and Phelps, now Kroll, they all, and BVR has size premium data as well. There are tons of sources that you can read about the theory and empirical observations regarding the size premium, much of it from Roger Ibbotson and Roger Grabowski over the last couple decades. And so a lot of this is discussed in textbooks that are already out. But to start, investment data, more sparse for small stocks. Analyst coverage tends to be less robust. So investors have to exert more effort per dollar invested to perform adequate analysis on a smaller company. This could, in theory, make it more difficult to diversify away the risk of small stocks. Small firms have more difficulty protecting their market share from new industry entrants. Similarly, they have greater ability to dictate terms to vendors, set prices for consumers. Larger firms have a larger resource base as well as superior access to capital markets. This can make larger firms more resistant to adverse economic shocks and allow larger firms to spend more on research and development. The last quality I'll mention is depth of management and workforce, making risk kind of less concentrated within the company. And of course, these are just a few that I've chosen to list. It's not an exhaustive list at all. The theme here is that all these qualities make small companies more risky than a large company, or I should specifically say it makes an investment in a small company more risky than an investment in a large company. More risk, more expected return. There's your theory. Okay, let's talk on the other side of the coin now. A large number of critiques have emerged in this debate. Some critics, and keep in mind that what I'm going to talk here has been, I would say, these critiques span going back to probably the 80s at least. So last, 40 years. So this is an aggregation over about 4 decades of critiques. A number of critiques have emerged, and some critics have noted that smaller firms may have, for example, lower trading volume, which means possibly a lagged return relationship with market indices and hence an underestimated beta. And so we can imagine if we have an underestimated beta, it has a direct impact on the implied cost of equity through the modified CAPM. And so you can see how when the size premium is treated as a residual, it's like it's going to matter, right? But new approaches to data cleaning and beta calculation have attempted to correct for this. And some found that the size premium remained even after adjustments were made to the beta to account for underestimation. Others have thought maybe there was a data collection problem. In particular, delisted companies tend to be dropped from data sets. And since smaller firms are delisted more frequently, there might be survivorship bias in the numbers. Similarly, smaller firms have larger bid-ask spreads, meaning bid-ask bounce, which it might cause measured rates of return to be artificially larger. Bid-ask bounce is, as you buy and sell a stock, you buy from one side of the order book and you sell to the other, so the price kind of bounces back and forth between the ask price and the bid price, and it can give the illusion of higher average returns when none actually exist. So again, adjustments have been made to the data collection process to account for these possible data issues, and they appeared to only have a small effect. So in other words, these critiques were valid, but not necessarily enough to kind of overcome. They were easily overcome, I should say. They didn't seem to have a big effect on size premiums. And I could keep going and going through every critique. I'll spare you some time and skip to some of the more important critiques that remain at the center of the size premium controversy that do arguably have a large impact. And the first is time period. The time period over which the size premium is calculated. It's common practice today to use data going back to 1926. And there's actually a funny story behind this where we were, because we have Value Analytics does calculate size premiums ourselves. And so I'm just reading some questions. Question from Benjamin, J. Benjamin, do you have a view on which multiples are appropriate to size adjust? For example, can you perform the adjustment on enterprise value to EBITDA multiples? Actually, great question, because we're actually going to cover that very shortly. We basically break pricing multiples up into equity level multiples and enterprise level multiples, and you'll see that the methodology is slightly different for each, but in general, you can apply it to any multiple. So great question. So on time period, it's common practice to use data going back to 1926. And when we first started kind of diving into the size premium to see if it exists, we didn't have data going back that far. We had to hunt for data going back that far, and we were confused because we said the size premium is completely different from what we usually see. And then we learned after discussions with some academics, need data to go back further. And so it's not a coincidence that the data goes back to 1926. 1926 is the year where it's known that the data started to become a higher quality, but it's also basically necessary to go back almost that far to keep the size premium alive. Is this appropriate? I will not opine right now. I'll leave that for you to decide, but it's important to note that the size premium largely disappeared after Rolf Banz's research was published in 1981. And it's possible that the size premium disappeared because of its discovery. You can imagine how investors would maybe jump on small firms then to capture the premium, in turn pushing the price up, and then the size premium doesn't exist. Nonetheless, it is common practice to go back to 1926 when calculating the size premium that's used in valuation today. And that's whether you're dealing with BVR, Kroll, or any of or Value Analytics, any of the providers of the size premium. Another lesser known controversy stems from the averaging method used. Arithmetic averaging across excess security returns is the best practice, but there is a strong case to actually use geometric averaging. When the latter is used, geometric averaging, that is, the size premium is not as prevalent. Nonetheless, arithmetic averaging is still commonly used today. Lastly, I will mention liquidity. As already discussed, smaller firms tend to be less liquid than larger firms, as evidenced, for example, by larger bid-ask spreads. Is it possible that it is not, in fact, size that's driving higher returns, but rather higher returns reflect an illiquidity premium? Another question for the day. We do actually at Value Analytics, we have a paper being published any day now in the Value Examiner regarding our opinions regarding these critiques. So I won't discuss them any further now, but we're more than, if you reach out, we're more than happy to direct you to that article, and we can you'll see all of our opinions on the size premium. For now, I will simply end this discussion by saying, despite the controversy, the size premium is still alive and well in practice. It is very common to include the size premium in the cost of capital. I think it's safe to say it will be with us in the valuation community for the foreseeable future. So as long as it's accepted, we can continue to contour our methods to its existence. Okay. Gonna switch gears here. So if you recall from the previous slide, here, so size premium was the green component, and now beta, the blue component. We're going to talk about that real quickly. The beta variable in the modified CAPM formula. So we see that under the modified CAPM formula, the excess return that an equity enjoys depends on the degree to which the beta is higher or lower, because as you saw, it's multiplied by the beta. Recall that the beta variable is termed the systemic risk coefficient. The reason it's termed this way is that it communicates how correlated an equity is with the broader market. If you break down the formula for calculating the beta, we can see this explicitly. And that's what we've done for you here. You can see beta. There are different flavors of beta. We'll talk about that soon. But when you generally calculate beta, it's going to be through an ordinary least squares regression, in which case it will reduce to this formula. It's also worth noting that a company's systemic risk is thought to consist of two components. The first component is operating risk. This reflects the uncertainty inherent in a firm's cost structure. Think fixed versus variable costs. The second component is financial risk, which captures uncertainty attributable to a firm's capital structure or degree of leverage. So now when I'm going to say pseudo observe a company's systemic risk coefficient, we are observing a levered beta, right? That is, we're observing the beta that incorporates both operating and financial risk for a public company. However, it is possible to unlever the beta, stripping out the effects of financial leverage on your observed beta. And we see here one approach to unlevering the beta variable. So here we divided the levered beta by 1 plus the debt to equity ratio. This is known as the practitioner's method. It is a very accessible approach to unlevering the beta. It is not the only approach, but it is the most accessible. There are other more complicated approaches that require much more granular and unobservable data, like asset betas. But the simplicity of the practitioner's method makes it preferred by practitioners. I think that's probably where the name came from. As with any method, the practitioner's method carries with it a series of assumptions. I'll mention the first two most important here. First, we're assuming that the capital structure remains constant, which implies that a firm's debt grows in proportion to its firm level cash flows. We're also assuming that we can just discount the tax shield from tax deductible interest on debt at the same discount rate that's used for operating cash flows. So these are the key assumptions that if they're true, then unlevering the beta in this way should be valid. And basically what you'd be left with is the beta attributable to a company's operating operating risk, and you'd be kind of removing the firm's financial risk. And we'll get back to come back to this at the end on how to actually make the adjustment itself. So, and now to the question that was asked. Now that we've covered these components of a pricing multiple in detail, it's time to review the actual adjustments. Actually, before we do that, I just want to give viewers a quick reminder that there are two categorically different types of pricing multiples. There are pricing multiples that use equity level cash flows, and there are pricing multiples that use firm level cash flows. Price to earnings ratio is an example of an equity level cash flow, while enterprise value to EBITDA is an example of a firm level cash flow. Of course, the only difference here is which stakeholders the cash flow belongs to. If the cash flows can be used to remunerate both debt and equity holders, they're considered firm level. And if they can only be used to remunerate equity holders, then they're considered equity level. I only bring this up because the pricing multiples are different depending on whether the pricing multiple is equity level or firm level. Okay. So, starting with the size adjustment, we show here the adjustment for equity level pricing multiples. Because the cost of capital is just the cost of equity for equity level cash flows, the adjustment is super easy. We subtract the size premium of the public company from the cap rate and then add back the size premium of the private company. It's that easy. So what size premium should you use when doing this? Well, I'm just going to take a quick aside here. Generally, you'd categorize company into deciles based on size and then add or subtract the size premium corresponding to the associated decile, right? So in other words, take your public company that you have the pricing multiple from, categorize it based on its observed market capitalization into one of these deciles, and then you're going to subtract the size premium associated with that decile. When you add a size premium back in, you're going to do the exact same thing for your private company. Now, it's not lost on me that you don't know the market capitalization of your private company before you're done with the valuation. The idea here is you just need to link it to the correct decile, and decile 10 is less. For example, it's less than, I want to say 100 million, but it's such a high number that unless you're like bordering two deciles, generally speaking, you can make a good approximation as to which decile to categorize your private company in. And many of you are probably familiar with size premiums being presented this way. This is how it's been shown for quite some time. If you do have more granular premiums, for example, sometimes the 10th decile is broken into additional into quarters, then you can just as easily incorporate that, and we'll talk through that shortly. All right, next we have the adjustments for firm level pricing multiples. I think firm level pricing multiples are relied upon more, but it's just that's just an experience observation. It doesn't always hold. Of course, firm level cash flows must be discounted at the weighted average cost of capital, not the cost of equity, right? So it's going to be a weighted, the weighted average between the cost of equity and the cost of debt now. Recall that the weighted average cost of, sorry, I just said that. So the size premium only shows up in
It looks like we lost Derek for a minute. Let's see if he.
Sorry about that.
That's all right.
Do you have me?
Yeah, I can hear you.
Awesome. Sorry about that. Probably a connection issue, but I think we're all good. All right, we were talking about firm level pricing multiples. So recall that the weighted average cost of capital is a weighted average between the cost of equity and cost of debt. The size premium only shows up in the cost of equity, right? It doesn't show up in the cost of debt. So we can't just add and subtract the size premium directly anymore. Rather, we have to add and subtract only the portion of the size premium that makes up the equity component of the weighted average cost of capital. Quick question from Jessica. Thoughts on decile 10B versus decile 10 for very small companies? I encourage. I think that's one of those times where subjectivity is required based on the facts and circumstances. I think as far as the size premium goes, it's each is just as valid. You kind of got to make a decision from valuation to valuation, but I think there might be a preference for more granular. But at the same time, I've seen the 10th decile by itself used numerous times, so I don't think there's like a clear consensus on what to do there. All right, so we are adjusting the firm level multiple. So like I said, we have to add and subtract only the portion of the size premium that makes up the equity component of the weighted average cost of capital. This is still relatively straightforward, but slightly different. I want to pause and just explain the logic here from a high level. All we're doing in each of these adjustments is changing a component of the public company's pricing multiple. Specifically, we're changing the embedded size premium from that of the public company to that of the private company. That's all that's happening. After this adjustment is made, whatever multiple you choose, it should not be because the private company is smaller than the guideline public company. And what I mean there is because you're going to have a range, like a minimum, when you have your peer group, you're going to have a minimum multiple and a maximum multiple for all the different multiples, right? And then you have the average, quartiles, everything. Generally speaking, if you don't make any adjustments to the multiples, you should consider size when choosing subjectively which multiple to use within that range. If, however, you have applied a size adjustment, you've already incorporated size differences in an objective way. So when you then have a new range, an adjusted range of multiples from your peer group, you should now be choosing based on all the same criteria except for size. If you continued to include size in the consideration when choosing after making the adjustment, you'd essentially be double counting the impact of size. So if you make such an adjustment, a size adjustment to the multiples, the end selection of the pricing multiple should reflect other properties, like perhaps growth expectations or some other performance related justification, right? But with these adjustments made, size is already explicitly accounted for. So if the guideline group was a perfect comp set, so if it was perfectly comparable to your private firm other than size differences, you would probably just choose the median or average pricing multiple after adjusting for size. Okay. Question from John: how do you factor in company-specific risk premium in this analysis? So when you can actually still have a company-specific risk premium that you want to tack on. Generally, in my experience, for public companies, the company-specific risk premium was thought to be fairly low, mainly because if the company's public, you can kind of diversify away its idiosyncratic risk. So from a size premium calculation, it might not be super material for the actual size premium itself. With that said, when you're building up your own cost of capital for your private company, you can still include it all you want. And then what's happening here is we're just changing the public company pricing multiples. So it's okay to kind of, unless we thought idiosyncratic risk of public companies really changed the size premium, it's okay to continue to incorporate it and then just include company-specific risk premium for your private company. Great question. All right, so we can now move on to capitalization adjustments. Kind of put the size premium behind us for a second. We already covered how to unlever beta using the practitioner's method. The idea now, I'll cover that in a moment. The idea now is that we estimate the beta coefficient for each guideline public company, unlever it using the practitioner's method, and then relever it using the debt to equity ratio of the private company being valued. You can see that I used the subscript private here. This really just means the relevered beta using the private company's debt to equity ratio. The concept is really the same as before. One thing I'll point out again, just like we don't know the market capitalization of our private company in advance, we don't know the exact debt capitalization of our private company advance because it depends on the value. But again, you choose something close. You can make it iterative if you want. Like you do the method, get a value, and then you can go back in and tweak it. But generally speaking, just try and get as close as you can to what the approximated debt capitalization is of your private company. Okay. So what we're doing here is we're subtracting the public company's unadjusted levered beta multiplied by the equity risk premium, and then adding back the equity risk premium multiplied by the beta that has been unlevered and then relevered, right? So you've unlevered and relevered the beta using your private company, and then you're going to subtract the equity risk premium portion in the cost of equity, and then adding it back for your private company. So it's the same exact concept. In doing so, we have made an explicit adjustment to pricing multiples for capital structure differences between the guideline public companies and the private company being valued. I will point out here again that this is the adjustment for equity level pricing multiples. For firm level multiples, we would need to multiply each of these terms by the equity capitalization of the public companies. This is the exact same concept we just saw with the size adjustments. Quick question from Matt. Is it best practice to adjust multiples for each peer company and then make a selection, e.g. median, or adjust selected multiples? So it would be best practice when using these adjustments to adjust the multiples for each peer company and then make a selection. Yes, great question. I mean, I guess technically, yeah, because the adjustment itself is going to be on a public company by public company basis. So you actually couldn't even do it in the reverse order. It wouldn't like jive mechanically. Great question though. All right, so before we continue, I want to continue my high-level commentary. We all know there's a high degree of subjectivity in valuation. There's no avoiding that. No matter which approaches are used or which methods are implemented, there will be some input that requires subjectivity, right? It comes with the territory of valuation. These pricing multiple adjustments were introduced as a means to be slightly more data-driven when implementing the guideline public company method. I will note that variants of the adjustments presented here actually date back to the early 2000s. I didn't invent this. There was a split second where I thought that we were the first people implementing this, but I was very wrong, as should be expected. I can provide multiple published papers to anyone interested, including ours. We do have a paper published last year explaining these in even more excruciating detail. When I worked in valuation, I would make adjustments like this, but it would be more heuristic and less formal. Like I would do it on the fly. So this has all been an attempt to kind of formalize this treatment and make it more uniform. Another question come in. What about growth adjustments? Do you perform those? Great question. And this has actually been the most common, right? Because if you go back to slide 5, let me just go back to slide 5. Slide 6. Earnings growth is another component untouched in this whole thing, right? Like technically, if we also wanted to adjust the pricing multiple for growth, we could through this earnings growth component. The issue we've seen here is there's just no good, like the cost of equity has been very well handled like academically. There's a lot of different ways to approach it. The modified CAPM is one popular way. With earnings growth, there are just difficulties and a lot of subjectivity. Let me put it this way. You can make adjustments to the earnings growth, but it's going to be almost just as subjective as making adjustments to the multiples in the end anyways, because you're going to have to choose what is a representative earnings growth for the public company, for each public company. So from that standpoint, you're going to need to know, is every public company early stage, mature? Are are they already at a steady state growth rate? Is it a sustainable long-term growth rate? And then you're going to have to determine the same thing for your private company. And I actually have seen this done. They'll use 3 or 5 year average, and that's doable. It's just, I don't know. I think there's, if you're going to get more pushback, it's going to be probably in the growth area. But nonetheless, with that said, yeah, if there's a growth difference, you obviously want to make you want to do something about it. But I think no matter which way you go, you're still looking at subjective, a lot of subjectivity. So firm level adjustment seems to rely on, this is a question from Evan, firm level adjustments seem to rely on the assumption that EBITDA is a proxy for long-term free cash flow. Since we are using the weighted average cost of capital, how do you consider operational leverage? For example, capital intensive industries where there is a significant amount of depreciation and amortization, this would seemingly have an impact on the expected volatility or beta. Yeah, so recall that because we're treating this, right, so like we're treating, first of all, the adjustments apply to any level of cash flow. I want to point out that when we make an adjustment, we're trying painstakingly to isolate, right? So all of the characteristics of a company go into its level of cash flows and its level of pricing multiples. Like we can go and look at a stock price. It's whether we agree with the stock price or not, that is the stock price. And so there is something, and they have an actual historical performance, right? So these are observable. The pricing multiple is very observable. When we make an adjustment, we're kind of letting everything else, like the all else equal assumption, right? So whatever the other characteristics are, we're holding them as equal as possible, and we're only making an adjustment to just that embedded size premium. So if you make the size premium adjustment, it still might be on a multiple that's inappropriate or on a cash flow stream that's inappropriate. It's still up to the valuation analyst to decide, like, is this the right multiple? Is this the correct cash flow stream? A size adjustment doesn't solve those problems. The only problem it's going to solve is a size differential between public company and private company. So that's a great question. Yeah, it's still going to require expertise of the valuation analyst. Question from John: when you are unlevering beta, what level of debt do you use in the debt to equity variable? Is it total interest bearing debt or net debt with cash subtracted from total interest bearing debt? We will be using net debt. Net debt. Great question. Okay, I'm going to transition now to actually, sorry, I'm skipping one important thing. I'm going to go to the second to last slide real quickly. You may say, well, this is great and all, but it's a lot to follow. You may like to consider these types of adjustments, but it would take too long to incorporate into your reports. So we do have solutions for you. And this brings us to the last portion of our session. Subscribers to the Value Analytics Excel add-in through BVR will have access to a series of templates, one of which is a valuation template that has these pricing multiple adjustments built in. And that's the demo we're going to walk through real quickly. After minimal information provided by the analyst, with the click of a button, analysts can apply and remove these adjustments to pricing multiples together or individually. By together individually, I mean the size adjustment and the capitalization adjustment. You can do them both at the same time or just one, and observe the impact that they have on the multiples. So if you're interested in learning more or signing up for access to the Excel plugin or downloading these templates, this is the link. And Amanda or Elizabeth, I don't know if you want to add the link in the chat, but yes, you can access everything here. And actually, when I share my screen, I will show you what the site looks like. Also, here's my contact information. You can reach out to me or a BVR sales rep anytime to learn more. So moving on to my demo, I'm going to turn my camera off so that you're not distracted looking at me. And I'm going to share my screen. Give me just a moment. All right. Okay. I want to get confirmation. I'm going to assume you can all see my screen unless someone tells me otherwise. So let's just start. That link takes you here. This is the Value Analytics Excel add-in page on BVR. At the bottom of the screen, under the downloads, we have a whole bunch of material for you. You can see information about the Excel add-in. A few things to point out. the valuation templates that we're about to walk through are available right here for download. You click it, you get a zip file. I will say that when you sign up for the Excel plugin, you have to add it in Excel. It takes about a total of 3 minutes. Very, very easy. We and the BVR team can help with that. And also, one of the handouts right here, this is the paper that we've been basically presenting. It was published last year in the Value Examiner, Size and Capitalization Adjustments for Market-Based Pricing Multiples. That is also available on the site. So this is, we encourage you to go check it out. And if you like it, feel free to ask us questions, ask the sales reps questions as well. So let's dive into the actual. So one of the templates that is provided is called the valuation template. And when you open it, this is what you see. And I'm just going to point out all of this right here can be ignored for the moment. This is, if you don't want to use any adjustments, then all you do is fill in the valuation date and you fill in your tickers, and it will pre-populate information through all these tabs, allowing you to perform a guideline public company method if you so choose. However, if you would also like to adjust your pricing multiples, that's where these come in. And you can see here, capitalization adjustments, it's set to no. Size adjustments set to no, means both of them are off right now. I've pre-populated 20 tickers in here. I mean, it's very, I think I've done maybe one over my decade-long career in valuation. I think I did maybe one valuation that had this many tickers. For the most part, 5 to 8, I would pretty usually see. But I've just pre-chosen completely random tickers for this analysis, so don't put any stock into those. Let's start with the size adjustments, and I'm going to show you one thing. So flowing through here, just to give you a feel for what's on the tabs, it's basically just an overview of performance metrics. So you have all the companies here going off, and you got a whole bunch of performance metrics listed. We also have performance ranking across a whole bunch of different metrics, enterprise value calculation and debt capitalization calculation, and then the meat and potatoes, the pricing multiples. We have a whole host of pricing multiples. It may not be completely exhaustive, but we think a lot of what people would want are in here. Keep in mind, this is Excel, so it's super customizable. So we actually have had clients ask us for different flavors of this, and we're more than happy to adjust in any way that you would want. But for right now, this is the default view, and you can see all the companies listed along with, so for example, this is market value of equity to last fiscal year earnings, right? And so that's this value for all them. Then we got 5-year averages, 3-year averages going all the way down. And at the bottom, we have all the statistics, as well as the selected multiple. So the selected multiple, you can set it to whatever you want. Like we have here medium, you can change it to be any of these. We're going to leave it on medium for now. And then we have this field decrement, right? And decrement is 0 right now because we have not actually applied any adjustments. So if you don't apply adjustments, you can completely ignore that field. But say we wanted to apply the size adjustment. Let's walk through some of the information that you will need. First, decile approach. There's 2 options here, step or linear. What this is meant to do is to accommodate the different ways that the size premiums are presented. Sometimes they're presented for deciles using the average. Sometimes they're more commonly they're presented for deciles in a range, like a min and a max for that decile. That's going to be how your that's going to be how you so if you use like Kroll or BVR, you're going to see like a decile, say decile 8 has a minimum and a maximum market capitalization and then an associated premium. If that's how you're digesting it, then you're going to want to use decile approach step. So it's set to the default. You never have to touch it if you use BVR or Kroll. Size premium data would only be if you use value analytics size premium data that you would switch this to the other one. But for right now, you don't even have to worry about that. Okay, a couple other things. Now we do have comments in here describing what each field should be. This is just the market capitalization for your private company. And again, it's an approximation. We're just using this to categorize your private company into a decile. If you do want to use more granular, so when you put this market capitalization in, it's going to automatically spit out what the size premium is for your private company. And you'll notice here we're let's see. Yeah, 3.85. Yeah. So then if you did want to incorporate more granular size premium data, you can actually hard code over this and it won't be a problem. You would just put in the size premium that you want to use for, like, say 10A or 10B or 10Z, whatever it is you're using, 10Y or 10Z. You just hard code it here. Equity risk premium, we allow the user to put this in themselves. This is usually provided by the same provider as it's usually provided as the same provider as like whoever's giving you size premium data. They'll also have equity risk premium data for you. So yeah, something to think about. And then this is the size premium data. And we do have guidance here. You're going to record the minimum size premium for each. You're going to record the minimum size for each decile, right? So in other words, when you go and look at your size premium data, you're going to get the minimum, and you're just going to put the minimum in here, and then the next minimum is taken as the maximum. So it reads it all. Okay, and then you're going to actually give the size premium associated with each decile. Okay, so I'm going to stop there. This is everything that you're providing to really. This is everything that you're providing to us in order to apply these adjustments. I'm going to stop there, answer some questions. Is this better than or replace the cost of capital professional? That's so actually no, because you do need the size premium data to be input here. So you're going to need the cost of capital, some cost of capital provider. That was a question from David. A question from Mark: what is the source of the data imported to Excel? Is it covering global stocks, etc.? So the data in here right now is not even from 2024. It's older data. It's like the default drop in. It's meant to be overwritten, but you would obviously want to. If you're doing evaluation with a valuation date in, say, 2023, then you're going to want to use size premium data relevant to that year. If it's older, you're going to want to use size premium data that's relevant to the year in which you're actually doing your evaluation date lies. Yeah. So, okay. So if I change this to yes, it's going to turn the method on. And what you can see here is when I go to pricing multiples, they're all changed. They now, the decrement is shown. And what this is telling you is the percentage decrease or percentage decrement from the original selected multiple. So this will give you, this immediately quantifies the impact of the size premium on the pricing multiples. You can see it across the board, and you can see, for example, we're on earnings multiples, like price earnings multiples here. But if you can see roughly, maybe 25, 30% thereabouts. Whereas if you start moving over to what's this, book equity sales, like you can see that it's a much smaller impact on multiples. Okay, so now I'm going to undo that. So it's to no. Now, capitalization adjustment, exact same thing. All we need to do is provide two things. One, the approximate debt capitalization of our private company. It's defaults and it's just written 10% right now, but you'll want to change this to whatever approximately you think where it will land. And then you want to input a beta. You want to input a beta estimate for each of your public companies. Now, I'm going to share a separate template just for 1 second. This is the value analytics beta template. It is available on BVR, where I had already mentioned under the under downloads and under evaluation templates. One of them is the beta template. And we give you a whole host of beta estimates that can be used. We take the average. We have had clients who prefer beta to be calculated in very specific ways. For example, some clients have said that they have auditors who don't want Excel pre-used Excel formulas to be used. All right, we are using covariance and variance formulas. So if you have a strict auditor who doesn't want if you have a strict auditor who doesn't want you to use preset Excel formulas, we have a separate template that we could always forward to you that does not use that. Punch in the valuation date, punch in a ticker, and it's going to automatically pre-populate all this data, and it's going to give you a new beta estimate. You can then take those beta estimates and put them in here, and that's what I've done. Some of them may be, I'm not exactly sure when I took these numbers, it was a little while ago, but yeah, they are beta estimates for each of the tickers. And you're done. All you then would do is select yes and go to the pricing multiples, and you'll now see new decrements. These multiples have been adjusted for leverage. You'll notice that decrements are negative. A negative decrement would be a premium, an increase. So that means that the pricing multiple has actually increased from applying the size adjustment. Also possible to stack them. I'm going to turn them both on at the same time, and you will see the combined impact of using both premiums. So yeah, so if you look at the decrement, you can now see where the pricing multiple stands relative to the unadjusted pricing multiple when using both the size and capitalization adjustments. Quick question from John: does the spreadsheet adjust price? I'm assuming that's price revenue multiples, and yes, we have. Where are they? We use the term sales instead of revenue, but yeah, it's EV sales revenues, or sorry, EV to sales multiples, and you can see the adjustments there. And like I said, if there's like some other multiple that someone wants to use, it has happened, and we're more than happy to help set that up. And that concludes the demonstration for the price multiple adjustments. I think we've covered the methodology, and we've covered kind of this practical application available to BVR Excel plugin users for the Value Analytics Excel plugin. So I will open to, I'm going to stop sharing my screen. Turn my camera back on, and we're open to any questions. Question: has someone peer reviewed your calculations? Yes. Yes. I mean, we've had practitioners using it who have passed audit. We go in and review them periodically. We've had several people look at them. It hasn't been through peer review of like a journal, if that's what you're referring to. But we're also, by the way, happy if you reach out to us, we're happy to walk through them, and so you can see kind of the nuts and bolts. A lot of the calculations are hidden in hidden cells, so we're happy to walk through. Yeah, great question, James. Linda, what should we do with this? Do we use the decrement to adjust something? So the decrement is just showing how much the pricing multiple had changed, right? So if the pricing multiple unadjusted was say 20, and then after we applied the adjustment, the multiple was say 10, that would be a 50% decrement. So it's just giving you an indication of how much your adjustments have actually moved the pricing multiples. Once you have those adjusted pricing multiples, you just go ahead and complete the guideline public company analysis as you normally would. And to be clear, when we applied those adjustments, I was just focusing on the selected multiple. But what was actually happening was above all of the, and I could share my screen again and show, but all of the public company pricing multiples were being changed. It wasn't just the end multiples, every single component multiple. Question from Jackson: has this methodology ever been used in a litigation context? So the answer is I don't know, but like I said, this methodology is actually not new. It dates back to, I want to say, at least 2003. I myself, when I worked in valuation, did not do litigation. We did almost everything except litigation, so I can't speak to it. However, it does have, in fact, on the BVR downloads that I linked to, in there is pre-written Word file where we actually explain it's meant to be copied and pasted directly into a report. So if you're having trouble explaining, like, hey, I did this esoteric adjustment that I don't fully understand, but I want to write it up into the report, we have pre-written language that you can use to put it into a report, and that includes citations to papers that have been published in peer-reviewed journals supporting the methodology. Question from John: would you then apply the private company discount studies to these multiples? Yeah, actually, if you have discount for, like, say, lack of control or lack of marketability on your concluded value, you could technically just apply them to the whether you apply them to the multiples or apply them to your concluded multiple or your conclusion of value, it's going to be the same. It's going to be the same impact. So yeah, you could apply the discount studies pretty much wherever you'd like within the analysis. Question from Chris, and this was kind of touched on a little bit, but not in more detail. So the tool addresses differences in size and leverage, but have you figured out how to quantitatively adjust the multiples for differences in growth and profitability? So the growth we talked about for a second there, where you could technically adjust based on the earnings growth within the same framework. It's just that there's a lot of subjectivity still required for it. It's not. I don't think it's going to relieve you of burden of trying to. It's not going to relieve you of burden of having to support the adjustments you're making for profitability. Profitability, unfortunately, wouldn't even fit in at all. So that's still going to have to be kind of on you each valuation to determine what subjective adjustment is best. Oh, a comment from James. He has used this broad approach in litigation, so hopefully that's helpful. Question from John: do you think it's appropriate to apply the guideline public company method to companies with revenues less than 100 million? I think I tried to touch on this a little bit earlier in terms of there are certainly situations where the answer is a hard no, right? And I think we all, being working in valuation, know that the answer is a hard no a lot of the time. However, there's a difference, I think, in our opinion, between considering a method and relying upon it. So, in this can stem from interpretation of revenue ruling 5960, but should it be considered? I think that there's an argument to be made that it should be considered on a lot of companies, even if it's not relied upon, or even if it receives low weight in the final valuation. And I will say that included in decile 10 consists of companies under 100 million. So I do think that at the very least you can begin to incorporate size adjustments for firms just small. Though I agree, as you approach zero, the size premium certainly becomes more dubious. Even if you're using more granular size premiums like the 10Y and 10Z, there is going to be increased burden on you to support no matter what. So yeah, great question, John. If there are no other questions, I'm happy to. Again, my contact information is in the slides, so please don't hesitate to reach out. We love talking valuation, and have a great day, everyone. We hope you go get the Excel plugin through BVR. We'd be happy to serve you.
Well, on behalf of BVR, I want to thank Derek and Adam for an excellent presentation, and I want to thank our listeners for attending and for your questions. As a reminder, to receive CE credit, you must complete and submit a brief survey on this webinar. A link to the survey is provided in your login email and on the reading page for today's webinar. Your feedback is key to providing the best possible programs for you, so please provide us with any suggestions you may have. If you choose to fill out a survey now, your browser will automatically direct you to the CE credit page when I finish speaking, so don't disconnect. The survey will be active for 5 days. and must be completed before we can process certificates. After 5 business days, we'll process your CE and send your certificates via email. If you have any questions related to the content or format of this webinar, please email me at training@bvresources.com. Coming up for more BVR webinars, we have on June 12th, Ashok Abbott presenting on blockage and DLOM discounts. And on June 17th, we have the first webinar in our new compelling case study series titled Case Studies in the Context of Goodwill and Divorce Litigation. You can find additional offerings on our calendar page as well under live events. Thank you all for listening. Have a great rest of your day. We're going to end this webinar now, so please go ahead and fill out the survey.